Welcome to the Cornerstone Investment Management and Consulting Chartbook for April of 2009. Our title this month is 20 Reasons We Do Not Believe the World is Going to End. And we're going to discuss some charts and graphs that indicate to us that the economy is improving even though the stock market has just begun to turn around. First, let's put this recession into perspective. A lot of people have tried to compare this to the Great Depression, and while this is a very challenging environment, if you look at the chart, you see that our overall economic situation is not as dire as it was in the Great Depression. But remember, the Great Depression was a combination of a bubble, a monetary contraction, and protectionist policies, all wrapped into one. We have knowledge and an understanding of that event that helps us. And another thing that's important to point out is stocks had increased 4 times in the 6 years prior to the Great Depression. Industrial production is another measure that we look at, in this case, year-over-year change in industrial production. While manufacturing is not as important a part of the U.S. economy as it once was, you can tell that year-over-year changes in industrial production are not nearly as dire as they were during the Great Depression. Now let's take a look at a couple of measures of risk aversion. The U.S. Treasury 2-year bond is about as liquid an instrument as there is, and it's very economically sensitive. You also see that in December we reached a bottom. The TED spread is the difference between what banks have to pay to borrow money and what the government has to pay to borrow money. The spike that you see in October was a very scary time, but you see that this measure has moderated since that point. We have some additional measures of risk aversion to demonstrate for you. First is the volatility index, which is commonly known as the VIX, which declined from its high, which was an all-time high of 90 to around 45 recently. In addition, the U.S. Treasury 3-month T-bill, which demonstrates that people were very, very risk averse towards the end of the fourth quarter. Moving now to different types of economic indicators. Copper is an important component in the manufacturing process and indicates that based on its recent bottom, we have moved forward and the market is anticipating a rebound from recent weakness. The Baltic Dry Index is an obscure measure of international freight costs, and what this tells us is international freight really bottomed out in recent months. It declined about 95% from its peak, and it has rebounded off of that enough to consider that more than just slight. The U.S. Treasury yield curve is the difference between what the U.S. Treasury has to pay on its long-term bonds and on its short-term bonds, and we presently have an upwardly sloping yield curve, which is a sign that the market anticipates economic growth. So this is yet another positive. Finally, the credit spreads. Credit spread is the difference between what junk bond holders have to pay in interest and what less risky borrowers have to pay in interest. So this is the difference between junk bond holders and U.S. Treasuries, and this spread has contracted considerably in recent months off of, again, an all-time high that we hit in the fourth quarter. The chart that we've provided here is the Institute of Supply Management's manufacturing report on a year-over-year basis. The red sections of the chart indicate recessionary conditions, and while this report is not very pretty, what you do see is, again, a situation where the economy seemed to have bottomed in the late fourth quarter of 2008. Corporate profits as a percentage of GDP was included because of that section on the far right-hand side of the chart. You see where the trend line was where the actual line was considerably above the trend line was a result of financial engineering and skewed incentives. This distorted capitalism and even threatened capitalism, and that is the point of this chart, is we have gotten back in line with those expectations. Personal savings rate. Our personal savings rate as a nation has gone from roughly 1% in the past couple of years to just shy of 4.5% recently. This is a tremendous step, but it means that air has been taken out of the sails of the economy. Now, some of the reasons for that are people have started spending less. As you can see by this chart here, retail sales as a percentage of personal income has fallen tremendously. Overall, this is a good thing as consumers begin to behave more responsibly, but it means that the consumer cannot be the primary engine of growth for our economy going forward. The reason we have a picture of Representative Kanjorski as one of our top 20 reasons why we don't think the world is coming to an end is because of his understanding of mark-to-market accounting. Simply put, mark-to-market accounting was forcing financial institutions to value their assets in a fire sale environment. It would be akin to you putting a sign in your yard for your house and attempting to sell it for what you thought was a reasonable price. But if nobody came along and offered a bid in 30 days, an institution that had regulatory authority over you told you that you had to mark it down to pennies on the dollar. And that's why we support the lessening of the rules for mark-to-market. Another sign that things are bottoming is that we have had a recent uptick in the price of homes in San Diego, California. It was home prices, and specifically home prices in California, that precipitated this problem, and there might be a possibility that they're leading us out. We also take a look at national home prices. Now, while we do not believe there is a national market for real estate, this is a useful measure to help us understand, and it appears that we're getting some different signals from some of the indicators, but for the most part, the indicators are pointing in a positive direction. Now let's talk about the opportunity we have. We've talked about some of the reasons that we think the economy has bottomed. We think that a lot of bad news is factored in, and this is all reflected in this particular chart. Typically, the market capitalization of the major index trades at a 1-to-1 relationship with nominal GDP. That's gross domestic product. What we see is when we adjust this for interest rates, this relationship has become significantly skewed. And that's why we believe we have an opportunity of upside, potentially 60 to 65%. The value line information supports that. The number that we're pointing to in this particular chart is the 175% expected return for 3 to 5 years for the stocks that are in the value line universe. That is very significant and maybe a slight overestimate, but we think that there's some validity to that number. Next, we have price to earnings ratio for the S&P 500. And again, one of the reasons that we've dealt with this crisis is because of slumping earnings. But a lot of these earnings are specifically associated with individual companies that are reporting very, very negative earnings. When you take that out of the equation, the price to earnings X negative, when those companies are taken out, is between 10 and 11. And that is very, very strong. We also see a chart that demonstrates that the price to earnings ratio for the S&P 500 typically fluctuates between 18 and 20 when inflation is in check. Now, we may be entering an environment where inflation is a challenge because of monetary policy, but we don't really know whether that's the case or not right now. What we do know is the market has priced in a lot of mistakes, and some mistakes that we haven't even contemplated, and that's why we feel fairly bullish about things. We have provided some commentary as to why we do not believe this is a second coming of the Great Depression. We've offered a number of measures that we use to analyze the risk capacity of the marketplace, which all point to a positive sign. We've offered up a number of economic indicators that point to the bottom of the market as being the latter half of the fourth quarter of 2008. We've identified the opportunity set that we think is out there, both in terms of fundamentals from the S&P 500 as well as opportunity that Value Line provides for us, as long as we stay within a reasonable inflation environment. What we believe has happened, though, is the market has overreacted to the shock of the system associated with financial companies deleveraging and then there being no market for a number of the assets that are on their balance sheet, which wreaked a lot of havoc in the system as a whole. We do believe that the consumer recession will likely last a longer time than a lot of people are anticipating, and that's because people have stopped spending money as frivolously as they once did. Overall, this is a good thing and it's healthy for the economy, but it means we're going to wander in the desert for a little bit. We do feel like there's opportunity. We feel like it's going to take a little bit of time for the system to work through that opportunity. Much of what we've had in the past couple of weeks is simply a bounce off of ridiculously low bottoms that were caused by a potential bear run on the financial system. Overall, we're positive, but we remain cautiously positive. We think that there's a tremendous amount of opportunity, and we thank you for the opportunity to serve you.